We're going to see big moves up in gold and silver, and even bigger moves up into gold and silver mining stocks. So again, if you don't own the miners, you should be buying them. These gold mining stocks are making a fortune, and they're going to make an even bigger fortune as the price of gold and silver continue to go up.
Do not trust the government data to guide your moves in precious metals. Their incentive is to mislead.
When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% increase. And when you go from $4,000 an ounce to $5,000 an ounce, that's a 25% increase. The point is, there's still $1,000 leaps. And if you have 50 ounces of gold and it goes up $1,000 an ounce, you just made $50,000.
In today's episode, three financial experts, Peter Schiff, Andy Schectman, and Jim Rickards, share their gold and silver price prediction for Q4 2025 and explain the current macroeconomic drivers behind the massive moves in the precious metals complex. They discuss the impact of central bank policy, inflationary pressures, government debt, and the weakening U.S. dollar, while also addressing the growing role of geopolitics and de-dollarization in shaping market dynamics. This conversation dives into why precious metals remain a critical hedge against systemic risk, what investors should watch for in the final quarter of the year, and how gold and silver could respond to ongoing global uncertainty. We watched hours of footage to bring you the best clips of the week, so you don't have to. If you're a serious stacker, this video is for you. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So, in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress. This is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know. I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a
In today's news recap, gold is forecast to rise 6% by the middle of 2026. The price of gold is forecast by Goldman Sachs Research to rise 6% through the middle of 2026 as of September 24th, underpinned by fresh demand from key groups of buyers who have contributed to a series of record highs for the yellow metal. The precious metal has risen more than 40% in 2025 and is on pace for its third straight year of double digits gains. The gold price is predicted to rise to $4,000 per troy ounce by the middle of next year, up from $3,772 on September 24th. Goldman Sachs research analyst Lena Thomas writes in the team's report. Their gold price forecast is driven by strong structural demand from central banks and easing from the U.S. Federal Reserve, which supports ETF demand for gold. Buyers of gold fall into two broad groups, according to Goldman Sachs research. Conviction buyers tend to purchase the yellow metal consistently, regardless of the price, and based on their view on the economy or to hedge risk. These include central banks, exchange-traded funds, and speculators. Their thesis-driven flows set the price direction. As a rule of thumb, every 100 tons of net purchases by these conviction holders corresponds to a 1.7% rise in the gold price. By contrast, opportunistic buyers such as households in emerging markets step in when they believe the price is right. They may provide a floor under prices on the way down and resistance on the way up. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
We're in a major gold bull market. The point I make is that this is going to continue, and a lot of investors asked me, say, well, hey, Jim, you said buy gold when it was 1,500. It's, 3,700, kind of teasing around $3,800 an ounce right now. Did I miss the boat? And my answer is, well, you missed, $1,300 worth, but no, or sorry, $2,300 worth, but no, you did not miss the boat. This rally is really just getting started. There are three main drivers. The first one is central bank buying. Now, 2010 was the year of inflection, meaning from 1970 to 2010, central banks and finance ministries, basically official institutions, were net sellers of gold. Beginning in 2010, they became net buyers of gold. Now, different central banks involved, Switzerland, UK, Australia, Canada were all sellers, still are. The Swiss have stopped selling. Canada, I think, sold all their gold. Not saying I have a treasure chest, but I think I have more gold personally than the government of Canada. So those some of those countries are still sellers, or at least they've kind of dialed it down to zero. The buyers are new. They're Russia, China, India, Japan, believe it or not, Turkey, Iran. Iran's not transparent, but there's a whole set of buyers out there. Vietnam, for its size, is buying a lot of gold, and they continue to do so. Now, central banks, to be clear, they're very savvy buyers. They're not going to drive the market a lot higher by themselves, and they don't want to. If you were a buyer, why would you want the price to go up a lot? You'd say, hey, I'm still buying, so I just as soon keep it low for a period of time. But what they do is they put a floor under the market. They buy the dips. I hate to use cliches, but they do buy the dips. They put in standing orders. Russia for a long time was sort of 10 tons a month. Put in the orders with dealers in London. They don't want to disrupt the market, et cetera. But if you're an investor in gold, if you're any, an individual, everyday American, or hedge fund or whatever, and you're interested, you have limited downside because the central banks are putting in a floor, but unlimited upside for reasons we'll talk about. So that's what I call an asymmetric trade. It's a very nice trade. The second reason is, good old fashioned supply and demand. You learn in your first week of economics courses. Might be the only thing you learn that's really valuable the way they teach it these days. But global output has been flat around 4,000 metric tons per year. That's all the mining in the world for about 6 years. Now, I'm not saying peak gold. It hasn't gone down, but it hasn't gone up. Just a little bit around the edges, but not very much. Right around 4,000 metric tons a year. So if you have constant supply, which we have, and increasing demand, which we do, that means the price goes up. It's just, limited, flat supply, increasing demand, price goes up. It's pretty much that simple. The third factor is that people say, gold's an inflation hedge. It can be an inflation hedge. The correlation between gold and inflation is less strong than most people assume. But I call gold the everything hedge, meaning, will it hedge inflation? Yeah, it actually hedges deflation. People don't understand. During the Great Depression, the best performing stock on the New York Stock Exchange was Homestake Mining, which was one of the largest mines in the world at the time. That's actually the foundation of the Hearst fortune, going back to George Hearst in the late 19th century. But I visited that mine, it's out in Lead, South Dakota. It's an open pit mine and an underground mine. They're not producing now. They produced up until around the year 2000, but certainly in the 1930s, one of the largest gold mines in the world. That stock went up at a time when the Dow Jones Industrial Index fell 82%. From October 1929 to June 1932, which was the bottom, almost 3 years, the stock market fell over 80%, but Homestake Mining went up, and it was the best performing stock on the New York Stock Exchange. Gold itself went up 75%, during the Great Depression. It went from $20.67 an ounce to $35 an ounce, which measured in dollars, that's a 7% increase during the greatest sustained period of deflation in U.S. history. So the history of the Great Depression says when stocks are crashing and deflation takes over, gold goes up significantly. So it hedges that. It also hedges inflation because, again, as we saw in the late 1970s, in 1979, 1980, inflation was 13, 15%. U.S. Treasury notes were yielding, 10-year maturity was yielding 15%. You could have bought a 10-year Treasury note that would pay you 15% a year for the next 10 years. But from 1971 to January 1980, gold went up 2,100%. So it hedges deflation, it hedges inflation, it hedges social unrest, natural disasters, civil wars, regular wars, et cetera, and uncertainty in general. So it's very good in that sense.
JP Morgan Private Bank. Gold is expected to continue reaching new highs with a mid-2026 price outlook of $4,050 to $4,150 per ounce. According to Jitong Finance APP, Chen Weihang, global investment strategist at JP Morgan Private Bank, stated that the outlook for gold prices by mid-2026 is $4,050 to $4,150. It is expected that gold will continue to reach new highs in the future. Chen Weihang noted that although Federal Reserve Chair Jerome Powell's remarks did not provide a clear timetable for future interest rate cuts, the bank still anticipates that the Fed will continue to cut rates if the U.S. economic conditions weaken further. Gold typically performs better in a low interest rate environment because lower yields reduce the opportunity cost of holding non-interest-bearing metals. With gold's recent rise, investors may consider gaining better entry points through structured products. Previously, Federal Reserve Chair Jerome Powell stated that the current policy stance is moderately tight, allowing the Fed flexibility to respond to economic needs. However, Powell also pointed out that potential deterioration in inflation and employment could bring two-way risks, and there is no risk-free path for the interest rate outlook. The remarks of other Fed officials were not entirely consistent with Powell's. Goolsbee of Chicago believes that although the neutral interest rate should be lower than current levels, the Fed should remain cautious going forward. Bowman, on the other hand, took a more dovish stance, warning that the Fed should act decisively to avoid falling behind the economic curve. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
And the markets gapped up quite a bit on Monday. Maybe $40 higher on gold, $1 higher on silver. So if you bought on Friday night, Saturday, Sunday through Schiff Gold, you got a great price, right? Because the market didn't even move until later Sunday night, right? So you had plenty of time. And I'm going to give the same advice this weekend. Buy your gold and silver over the weekend. Don't wait for Monday. We got 2 more days of the quarter. And I think they're going to be big for gold and silver. I think Wall Street now, and I mentioned this last week, now that you got Morgan Stanley is saying we have a 60-20-20 portfolio. You've got Wall Street for the first time in my career. I've been a stockbroker since 1987. I've been in the investing business. And for the first time, I'm not the only one telling people to buy gold and silver. Wall Street is now saying the same thing. And 20% of a portfolio in gold, that's a big percentage. That's not chump change. That's a lot of money that's going to be coming in to gold. Now, not all at once, but pretty much every day for the next several years. I think it's the beginning of a huge wave of money, Wall Street money, that's going to be coming out of bonds and other fixed income into gold and gold-related equities. Because now, Wall Street is not worried about gold prices crashing. which they always were. Now they realize gold's going up, so these gold stocks are a bargain. And what's great about the gold bull market now is what it was missing before. Silver is now leading the way. That is a bullish sign. People always pointed to the weakness of silver as a lack of confirmation because all big gold bull markets, silver leads. Well, now silver is leading. Gold was up 0.5% today. Silver was up 2%. Silver closed over $46. It traded over $46.50. Silver was up 8% on the week. So if you bought silver last weekend, like I told you to, in this market wrap, you're already up 8%. Gold was up 2.2% on the week. Year to date, silver's up 59%. 59. In fact, when it was at its peak, it was up 60%. Then it pulled back a bit. Gold is up 43% on the year. And the year's not even over. We got 2 more days left in the third quarter. I think the fourth quarter is going to be the strongest yet for gold and silver. And as I just mentioned, these next 2 days, a lot of portfolio managers are going to want to show their clients that they have some exposure to gold and silver, right? Better late than never. Of course, it's not late, but it's late in the quarter. So I think they're going to, window dress their portfolios. They're going to add some gold exposure if they don't already have it. So you're going to see, I think, money coming in to gold and silver and the mining stocks.
What do you think of Jim's take? Do you agree with him? Will gold and silver go significantly higher, or is a major top forming? Post in the comments section down below your gold and silver price predictions and share with the stackers if you're still buying at these prices or not. Now, watch this video right here because it's a perfect fit for you, and I'll see you on the other side.